Hi, we're so glad all of you have joined us today for our webinar. We're very excited about it. I'm Charlotte Yao. I'm Director of Business Development with Sweyer Property Management. We are doing this webinar series to help educate all of our investors and owners and future owners how to handle your investment property the best way. Our previous webinar, we had mortgage and financing. And with this webinar, we have Carl Williford, he's with Williford and Houston here in Wilmington, and he's going to be explaining to us the tax implications and the strategies for residential real estate investing, because I know we all have a lot of questions on how to handle it. So Carl, we look forward to everything you have to say, and thank you so much for joining us today. And
great.
Take it away.
Great. All right. Let me flip over here to my screen. Let me let everybody see all this wonderful tax information. You people are glutton for punishments. You've come to the tax seminar at the end of the day. All right. Well, Charlotte, thank you very much. Charlotte said I'm a CPA here in Wilmington, North Carolina, and it just been around for a long, long time. So I was trying to think of what I should call this talk, and so I came up with this title: "The Definitive Presentation of Tax and Economic Implications of Residential Rental Investments." And I thought, well, okay, maybe that's not quite what I should say. But before I go to what I should say, or maybe what I should be thinking about, if I can get my screen to go to the next, there we go. Let me tell you a quick little story. So there was this first mate. He joined this ship back in the colonial times, or when the British Empire was going really great. And so he joined the ship as a first mate. He went on the first day of the voyage, and he comes up to the captain and says, "Captain, we have a problem. There is a pirate ship looking to board us. What should we do?" Captain looked at first mate, said, "First mate, call them into battle stations and go get my red shirt." First mate does it. Captain puts on a red shirt. They fight heroically, fight off the pirate ship, move on. A little bit later in the day, first mate comes back to the captain again. "Captain, we have a problem. There are two pirate ships on either side of us looking to board us. What should we do?" He says, "First mate, call them into battle stations. Go get my red shirt." First mate does it. Captain puts on the red shirt. They fight again. Heroic battle. Fight off both ships. So the next morning, first mate looks on the horizon, runs to the captain. "Captain, we have a problem. There is an armada of ships approaching us, looking to board us. What should we do?" First mate, call them into battle station. Go get my red shirt. The first mate looks at the captain and says, "Captain, I don't get it. Why the red shirt?" And the captain says, "Well, son," he says, "two reasons. One, the men see me in the red shirt and it excites them like a raging bull and they fight harder. And two, if I were to go into battle and I started to bleed, they wouldn't see the blood and wouldn't panic." He says, "Captain, I have served with many captains, but you, sir, are the bravest captain I've ever served with. Here we are getting ready to fight off 100 pirate ships, and you're going to put on a red shirt." The captain said, "Excuse me, son, did you say 100 pirate ships?" "Yes, sir." He said, "Well, you better get the brown pants too." So the reason I tell that story every time I do a tax thing is taxes are complicated and there's a lot of information. And it's difficult sometimes to give you all of that information. So I'm going to give you some of the equation. I can't give it all to you. You couldn't absorb it all. The Internal Revenue Code and regulations are 4 million words. That just means that a bunch of politicians wrote it. So having said that, two things: taxes are complicated and they're only part of the economics of the business. So having said that, let's go on and think about maybe a better title for this would be a few things to consider when you're investing in residential real estate. All right. And so from a tax perspective, we're going to talk about a few things: pros and cons of residential rentals. We're going to talk a little bit about entity ownership, entity selection, maybe the different ways you want to own it. We're going to talk about how we calculate net rental income, because sometimes that becomes an issue. We're going to talk about this little concept called passive activity loss rules, or passive activity issues. We're going to talk a little bit more about depreciation. We get in a lot of those conversations with clients. We'll talk a little bit, y'all know you've talked about mortgages before. We'll talk a little bit about debt and interest deductions, just touch on that briefly. And then we'll talk about a few disposition strategies. And if we have time, there's a couple other issues I'd like to just bring your attention to, if you will. All right. So why in the world real estate? Well, most of you already know this. You've made this decision. But real estate is one of those, it's a great wealth strategy. There's a ready market for leverage, so you can take a somewhat modest investment to the total cost of the asset. You can leverage that with debt, and so that's a good way to multiply your net worth, if you will, off the income off the money you're investing. It's a great way to build passive income, wealth. It's traditionally low risk over time. There was an article the other day that talked about 90% of all millionaires in America are real estate investors. So it's just something to consider. If you want to be what I took that to be is if you want to be a millionaire, you better invest in some real estate. The cons, there is some risk, obviously, to real estate. There is some work related to it, even though it's not maybe as much work as an operating business that you work day to day in. And there's also, it's low liquidity. So those are issues you got to kind of overcome. And again, there are ways to do it. And that's what the good folks at Sawyer are going to help you with some of those processes, or some of those cons, if you will. All right. So let's talk about entity selection. How do you own the real estate? So there's several different ways you can own it. I mean, the easiest one is just you're an individual, you bought a piece of real estate, and you decide you're going to do something, you're going to rent it. All right, so that's pretty easy. The downside is you've got some liability exposure. And before I go any further, I want to say unequivocally, I'm just a CPA. I am not a lawyer. If I have said that not enough, just in case, for recording sakes, I am not a lawyer. I'm not giving you legal advice, but I'm going to share with you concepts or things that we know we deal with. And I've talked to a lot of lawyers in my line of work. So having said that, individuals, the problem is that you're exposed to all the liabilities of that if you just own it outright in your personal name. You can mitigate that with insurance, sure, but there is some liability there. So another way you might own it is a corporation. You may have owned a corporation or form a corporation to own your real estate. We typically don't see that unless you've made an S election. An S election is when you tell the IRS that this corporation is going to be a special kind of corporation in which the income and expenses are reported on a corporate return, but the taxes are not paid there. That income is passed through to the individual, and the income tax is paid, or the losses or deductions are made on the individual's return. We don't typically like having assets inside of corporations. They create problems for us later if we decide we want to move the property out. There is when we move property out of any kind of property, it comes out of a corporation. When it comes out, it must come out at fair market value. So if you paid $100,000 for that piece of property, and we'll ignore depreciation and all that stuff, and then later we're ready, for some reason we need to move it out of that corporation, need to put it in something else, we're supposed to take it at fair market value. If fair market value is $150,000, then we've created a gain of $50,000 that we've got to record and report to the IRS and pay taxes on, even though we may have only just put it in another entity that we own. So that's why we typically don't like corporations owning appreciating assets. The other way people will own things, especially if they have multiple owners, is a partnership, of course. That's very typical. It's very easy to establish a partnership. There is some liability or some asset protections inside those things. But again, it's a pass-through entity like an S corporation. The partnership doesn't pay tax. The partnership reports all the income and deductions, gives a K-1, it's a reporting form to the individuals, and they put it on their tax return. We typically aren't seeing as many partnerships in a traditional sense. What we are seeing is the next item, a limited liability company. And everybody and his brother has probably heard of this. You've probably heard of this kind of company. We like it because it's very, very flexible. It can be used by individuals. So if I'm a single person and I'm just I form an LLC and I buy a piece of property, well, for income tax purposes, it looks just like I owned it outright. I just report on my tax return. I don't have a separate tax return for the LLC. But I get some liability protections, as the attorneys tell me. Again, I'm not a lawyer. However, if you're a partnership or you're multiple owners, you can treat that LLC as a partnership, or by election, you can treat it as a corporation and even an S corporation. And we have some clients that do that for other reasons. Again, that's more of a legal question as to whether it makes sense for you to do that or not. But by far, most of our clients own their real estate inside an LLC, either as a single person or maybe a husband and wife or multiple owners. We typically see that. So that was probably the most likely one that you'll encounter, and maybe some of you already have set that up. Trust, we use them sometimes. They're very limited in use. They're very helpful if you're trying to do some kind of asset protection or asset preservation strategy, or if you're trying to deal with some estate tax issues. The problem with trust is that they are very complex in how the taxation works. I'll leave it there. We could do a whole seminar, 8 hours on trust, because I had to attend one a couple of weeks ago. We could do that again, but I don't think you want to do that today. So we'll leave it there. If you want to talk later about trust, we'll talk about that. I will touch on one thing about a trust. There is a specific kind of trust called a rev trust, a grantor trust, a living trust. You may have heard those kind of names. That's a little bit different. It's a trust that for IRS purposes, you generally kind of ignore. But a lot of my folks who have accumulated a lot of assets and don't want those assets exposed in an estate, filing with the clerk of court, they'll use a rev trust. You'll see that quite a bit. I don't want to confuse that too much. I just want to kind of make you aware that that exists. All right. Why did I tell you all that? Well, I told you that because it's going to come back to this. It's going to going back to be an issue for us in just a minute. Let's talk about net taxable rental income. How do we get there? So everybody wants to know, so the reason I'm going here will hopefully make sense a little bit as I get into this why I'm taking you through this computation. So net rental income, no matter how you own it, you're going to recalculate it the same way. It's your rent received, and then your deductions. What are they? Advertising, auto mileage. If you're an individual or partnership, maybe you have some auto miles just being driven. We used to typically take a cents per mile. It's currently at 62 cents per mile for the business mileage that you drive. That's, you're traveling to the property or properties you're moving around. That rate just got increased by the IRS this year. That's very unusual that they typically don't do that, but because gas prices went up so much, it's now at 62.5 cents a mile. Other things, association dues, commissions that you pay for a lease, insurance, interest. We'll talk a little bit more about mortgages and that kind of thing in just a minute. Repairs, we'll kind of come back into that a little bit when we talk about capitalization and some of the tangible asset regs. Other things, utilities, and then this thing, HOA dues, and then we have this thing called depreciation. And I'm going to touch a good bit of my time on that because we spend so much time talking to clients about what's depreciable, what's expensed, how do we run that depreciation, those kind of things. But before we get there, I want to touch on one other item, and this is a pretty important thing for individuals. So remember, I started off by saying you could own your assets either directly as an individual or a corporation or LLC. But then when I talked about corporations, I said, let's use S corporations. That means it's a pass-through entity. That means all this income is coming down and getting reported into the individual tax return. So the rules here, when I say for individuals, I'm assuming that very few of you, if any of you, have your entities in a corporation that's a C corporation where the corporation pays tax. If you've got it in a corporation, it's probably in an S corp, or it's probably in a partnership, or it's probably an LLC. Maybe it's in your individual name. So these rules are all going to apply. And the thing here is, rental income is ordinary income. So it's subject to your marginal tax rate. All that means is, you may have a job where you're working or some pensions or other income, and you kind of think of your taxable income as kind of stacking up. And as you stack it up, you come up in a higher and higher bracket. So if you have rental income, it's going to come in as ordinary income and be taxed at that marginal bracket. So that's kind of the way to think about it. And this will make sense a little bit when we give an example. However, we have these rules called the passive activity loss rules. They've been around a long time. They were in 1986 is when the act was established. It created this whole concept of passive activities. And generally losses from a passive activity, which rental property generally is, 99% of rental property is passive. There are a few exceptions, and we'll talk about a couple of those in a minute. But generally, those losses are allowed only to the extent you have passive income. So if you only have one property and you got losses, if you don't meet an exception, you can't take that loss. Now, what happens to that loss? You don't lose it. It just carries forward to the next year and the next year, and it keeps carrying forward until you have income, passive activity income that you can use to offset that loss. If for some reason you continue to have losses that you can't offset, and then you later sell that property or you dispose of it in a taxable disposition, typically think sale, I sell it to someone and I create a gain or loss, it doesn't matter, but whatever gets created, then those losses that I couldn't take before, I now can take them. So you don't ever lose them, except if you pass away. So if you have PALs, you have something to live for. You want to make sure you get those losses. Don't let the government cheat you out of your loss. So let's talk a little bit about the exceptions, about maybe some ways you might still be able to get those passive activity losses if you had a net loss. All right. So the first one is not too hard. There's a publication, 925. If you can't sleep one night, pull it out, start reading it, guaranteed to put you out in the first 3 minutes. If you last that long, you've done well. All right, so so in this publication, they define active participation because this first exception is somebody who's an active participant. Active participation is not a high threshold. It's pretty easy. You basically just need to make some bona fide management decisions. You need to be the person who's deciding who may be my tenant, or you're deciding the rental terms, or you're approving expenditures, any of those kind of things. If you're doing that, you can meet the definition of what active participation is. There are a few limits to your deductions under this exception. The losses that you can take are maximum losses are $25,000, and that's losses from all of your rental properties. So the whole year, you take all your properties that you're active participant in. If your net losses are 25,000 or more than 25,000, well, then you can only take up to 25,000 if you meet the second part of this or the third part of this. And third part of this is your adjusted gross income or modified adjusted gross income, and all that modification is it's your income before taking this loss. So we look at that. If your income is under 100,000, you can take the 25,000 fully. If it's between 100 and 150, every time we move up $2, we lose $1 of those losses. So once we get 150, we lose all the losses. You go, well, that's not very helpful if I'm making any money, and it isn't. So it's a limited exception, but it does apply to a lot of folks, more so than you would think. The second one that we see quite a bit here, and so this is only going to apply to certain folks, and that exception applies to real estate professionals. So if you're a real estate professional, you perform more than 750 hours of service in a real estate property trade or business, and this is the big and, this is the one people miss, and you're a material participant in that rental activity, and I'll talk a little bit about that in a minute, then your losses aren't limited at all. They're like regular old losses from regular old businesses. In other words, it's a way for the law to say, okay, you're a real estate professional, you're materially participating, so this is just like continuing your normal business. This is like your regular business. You're not passive. You're not a passive activity to you. Passive just simply means I'm not working day to day in it. But these rules are very defined, and the test for material participation, unfortunately, there are 7 of those, and they are fairly complex. These passive left activity laws have been around, like I said, since 1986. We are still working on trying to define certain issues, and there's still quite a bit of controversy in some of these, how these things apply. But for example, for a material participant, to be considered a material participant, you got to spend more than 500 hours in the activity. You say, well, my Lord, if I have one rental property, it's going to be hard for me to show because I got to demonstrate to the IRS I spent more than 500 hours on that activity. But there's another test. Another test is if you spend more than 100 hours during the year on that activity, and that's more than anybody else spent on that activity, well, you can apply. You say, well, Carl, 100 hours is still a lot of time. And so what a real estate professional can do is they can make a special election. Let's say you're a real estate professional and you've got 5 rental properties. You can elect to aggregate them. In other words, you make a special election to aggregate all those activities for purposes of these rules. And you say, under that rule, I can take all these activities and, hey, I spent more than 100 hours over those 5 activities, and that's more of the time than anybody else spent. And so now I'm a material participant. Now I can treat those losses from the entire group, the net loss from the entire group, I can take that deduction. So there are ways to deal with this, but these rules, I cannot stress enough, are complex. And we've had several audits in the last few years. We've had this challenge before. It's very important that you keep records of the time you spend. That doesn't mean you got to keep a time card, but you do need to keep some records if you want to sustain this. So I'm just kind of throwing it out there for folks will know that it exists. All right, so let's move on to the next topic I want to deal with is depreciation. Before we get into depreciation, we have to define a couple of things about depreciation. We have to understand what cost basis is. This is very important. So when you're buying the property, it's pretty easy. The cost is just what you paid for it. What's the cost of the property? That can get a little complicated, but usually that's pretty straightforward. If you inherit property from someone, so someone's passed away, and I think not a gift while they were living, but when they pass away, they've left you a piece of property. Your basis becomes the fair market value on the day they passed. And how do we figure that out? We typically get an appraisal at that time. And that establishes our basis. and establish our basis for depreciation if we're going to use that property as a rental property. If someone makes a gift to you, that we run into this a bunch. Somebody will come in and say, "Oh, I've got this property, and mom, dad gave it to me years ago, or somebody left it. They gave it to me while they were living." Well, now it's a little more complicated. We don't like this rule as much. So for depreciation purposes, and depreciation, remember, is how we're going to figure out our expenses. For depreciation purposes, and when we figure out the gain or loss, we figure out the gain on the property, we use the lower of the donor's basis. So back to mama left it to me. Mama bought it in 1926, and now she left it to me, and it's got a maybe $10,000 basis. Well, that's my basis for purposes of depreciation and purposes of fair market value. You say, "Carl, how in the world can I figure that out?" That's usually the biggest challenge. We usually have to do a lot of work if we have that situation. The takeaway I would give to you is, if that happens, if you see, if you're receiving property from someone, you need to think in terms, I need to get some information. Or better yet, you probably need to get to your tax person and say, "Hey, what do I need? Because I'm going to need some information here to figure this out. If I'm going to use that property, either you're going to sell the property or you're going to use it at some point, you need to figure out what that basis is." If for some reason you have a loss, now you're going to love this rule. This is a heads they win, tails you lose kind of situation. If you have a loss, well, we use the higher basis, the higher the fair market value or the basis of the person that gave it to you. So, for example, get back to the example before, mama's left you something. She paid it. Unfortunately, she bought it, in 2007, right before the crash in 2008, and she paid $500,000 for it. Now it's only worth, $300,000, and she gives it to you. Well, if you have a gain, you got to use $300,000 as your basis. But if you're going to have a loss on the sale because you sold it for $450, well, your loss is the lesser of it. Or excuse me, I said that right backwards. Your loss will be determined by the lower of the basis, mama's basis, or the fair market value, $300,000. So now I've got a very little bit of loss. I have no loss in that case, right? Because I'm selling for $450. Mama's cost basis was $300. So now I've got a gain. Don't like that, but that's what happens. So when you get gifts, we need to be very, very careful of understanding what the fair market value is and also what the cost basis is. Capitalization. Why am I going to talk about this? Capitalization is simply when we are trying to figure out, do we need to capitalize an asset? We're buying an asset. Do we need to capitalize it? This comes into play when we start renovating property, when we start buying things for the property. And there were regulations that were put out in 2013. Those regulations actually were one of some of the best regulations we've ever received. They provided a lot of clarity for us as to when to treat an expenditure as a capital asset as opposed that needs to be depreciated, or as an expenditure that we can expense as a deduction. And there was a couple of things. One very surprising thing that came out of it was this 2,500 de minimis selection that every person can make. Every business can make this. As Charlotte said before, your rental property is a business. And so you can make this for purposes of that rental property. It basically says, if I have an item that I'm buying and it's under $2,500 or less, I can just expense it, even though it would be something typically I would capitalize and I would depreciate. For example, I've got a refrigerator that I buy and I paid $1,900 for it. And before these regulations, everyone in my business would tell you, you got to take that refrigerator, you got to put it on depreciation schedule, you got to depreciate it over a 5-year period. That was the law. When these regulations come out, we went, oh, we can just make by election, we can elect this de minimis election. We do it annually on a return, and we just deduct it as a supply. And end of story. IRS can't challenge you on it. They can't question you about it. The one thing I'll tell you to be careful about, and we'll get into this a little bit when we start talking about renovations, is you can't componentize things. So, for example, I have someone to come in and say, look, I need you to put up some walls in this room. And they say, fine, that's going to be $8,000. And I go, man, I remember this guy talking about this $2,500 exception. So can you just sell me the lumber? Well, yeah, the lumber's $2,000. Oh, great, I can deduct that. And can you sell me the sheetrock? Well, yeah, the sheetrock's only $400. How about your labor? Well, that's only $1,000. And by the time you finish, you say, well, I've got $2,500 items. No, it doesn't work that way. So there are some rules in there that talk about you can't componentize an entire thing. You got to think in terms of what it really an item is. And so there's a whole bunch of rules. By the way, these regulations are kind of small. They're only 250 pages. So again, if you're really sleepy or can't sleep one night, pull those out, start reading them, and you'll find them very, very helpful for you. The other thing it really talks about is there's repairs and capital expenditures. So we talked about when is a repair, when is a capital expenditure. We'll touch on that a little bit. The law there is not as good as what we want it to be in the residential rental area. So let's go there. So what's a repair and what's a capitalized renovation? Again, capitalized simply means I've got to set up as an asset and I'm going to write off as depreciation. Depreciation is just simply the way we write things off. We write it off over a period of years. Sorry for this, but we're going to get into a little bit of rule. I promise I won't go too far into this, but I do need to kind of give you an idea of how we look at what repairs are as opposed to renovations. Generally, we got to capitalize items that you're spending that improve some unit of property. And I'll talk about what unit of property means in just a minute. The exceptions to that, there is one exception for safe harbor election. That election is fairly narrow. There are three components to the election of safe harbor for small taxpayers. First, the taxpayer's got to have less than $10 million in receipts. Most people are going to be able to qualify for that one. But the second one is the total value of the building can be no more than $1 million. Again, a lot of people can qualify for that one. The total amount during the year that you spend for repairs and maintenance and renovations together, as long as it does not exceed the lesser of $10,000 or 2% of the adjusted cost of the building. So if your building's over $500,000, it's $10,000, right? 2%, 500,000, $10,000. So generally, if you're spending more than $10,000, you got a problem. If you're spending less than $10,000, you may not have a problem unless your building's less than $500,000. If your building is only a $200,000 building, within your limits, $4,000. So that election, sometimes we do these little tests with our clients and we look at it to see if it makes sense. Because if you make that election, if that property qualifies, if that taxpayer qualifies and that property qualifies in within those limits, again, if you make the election, the IRS cannot challenge you. They can't come back and say, oh, we think this was a renovation. This $5,000, $8,000 you spent on this wall over here. I said, no. My guy or gal qualified from the small harbor election. We made it on the tax return, so I can deduct it. I don't have to worry about it. So that's one that is helpful in a lot of cases. The other one we talked about before, the $2,500 item exception. We talked a little bit about that. Again, that is an election. Got to make the election if you want to take it. Now, what is an improvement of a unit of property? What the heck is that? Well, there's three things that tell us it's an improvement. I either made it better, I restored the unit of property, or adapted it to some new use. And there's one other exception. If I have routine maintenance, so routine maintenance, typically the one we get asked about a bunch is somebody says, hey, I painted the place. Well, that's expensive, but it's routine maintenance. I got to paint it again and again and again. We know that. So that one we basically take. Routine maintenance, though, where you get into this is somebody down here says, hey, I got an HVAC unit. And the guy came in and said, hey, he's got to replace the condenser. And it's only been 7 years and the thing's supposed to last me 15 is the guarantee, whatever, it's 10, whatever it is. And dadgummit, I got to pay all this money. And they, they say it's going to extend the life. So that's a betterment. Can I deduct that? Well, it depends. This routine exception, you'd say, well, I heard about this routine maintenance. That's routine maintenance. The problem is when when the IRS wrote these rules, they said routine maintenance for a building activities is routine if you reasonably expect to perform them more than once in a 10-year period. So if it's every 7 years, that doesn't work. That's only once in a 10-year period. So that exists, but it's limited. I simply want you to be aware of it because you'll hear some people say, oh, well, that's maintenance. You don't have to worry about it. Now, I'm not saying you can't deduct it. What I'm saying is it doesn't fall under this exception. So let's talk about what units of property are. So for buildings, the regs, again, gave us a good bit of information. They said we're going to break down units of property. Buildings have certain building systems, HVAC, plumbing, electrical, escalators, don't see many of those. Elevators, we do see a lot of those. Fire protection alarm systems, security systems, gas distribution, and then structural components like your walls, your roof, your those things. So any of those units of property, we look and say, are we improving them? Are we restoring them? Are we making them, we're adapting for new use? If we're not doing those things, if we can definitively say, and there are 10 tests, I'm not going to take you through all those tests. I'm not going to do it. Don't have enough time. But there are 10 tests we can look at. Do we do that? I'll give you one quick example of something in the regs that was very surprising to us. Doesn't apply as much in the residential space, but could. And that is if you have a flat roof. So if anybody's ever had a flat roof, you know they put those membranes on, those rubber membranes, and those things over time they leak. They all leak. And so eventually you have to yank it up and put another one on. Well, that's a very expensive thing to do. But the regulations said, well, hey, you're not really improving it. You're just putting it back. You're not changing the roof. You're just repairing it. And they allow us to deduct that whole thing. That was one of the things when we started reading this, we couldn't believe we were reading this in IRS. These are IRS regulations. So this is statutory law. We can use this when we're trying to defend ourselves in front of the IRS if they want to challenge us. So those are the kind of things that are in there. Now, having said that, I know I may get a lot of questions on this one. If we get a bunch of these questions, we may take some of these offline because they'll get us very specific. But I want you to be aware that this is kind of what we're dealing with when we try to figure out, is a renovation, is it a repair? Those are the kind of things we look at. Let's talk a little bit about depreciation a little bit more. So what's depreciation? It's simply the way we write off the cost of something. So we've spent something for an asset that's going to last more than a year. So it's not like a supply. It's not like a towels or something, or dishes or something like. It's something it's substantial. It's going to last more than a year. And how do we write that off? Well, we have this publication 946, and it's only 110 pages. And for residential rentals, we usually deal with about 4 different categories. Land, we'd never depreciate land. So if you're buying a home and it's got sitting on a lot, well, there's land. You can't depreciate the land. Residential building, the building structure itself is 27 and a half years. We write that off over 27 and a half years. Land improvements, a lot of people miss these. Think things like driveways, swimming pools, sidewalks, fences, all those things. That's 20-year class life. Only in the IRS world, that means you can write it off over 15 years. If you're really bored one day and you really want to know why that is, I can go back and explain to you, but you don't want it now. Just suffice to know that it's a 20-year class life, but you write off over 15 years. That'll become very important in just a minute. And then it's things like furniture and fixtures. So a lot of rental units have carpet. A lot of them now. We used to see hardwoods and a lot of tile and those kind of things. Now we see this LVP because it's a really great product. It's very durable. It's not very expensive, relatively speaking. And that stuff is 5-year property and appliances that you have in a house. So those are kind of things we typically see. And a lot of times when people are buying something, they'll miss that. So we say, hey, maybe we need to spend a little bit of time on the very beginning when we're buying something to figure out what those things are. Let me give you one more thing about depreciation. So that's the typical way. So I just told you, like land improvements and furniture and fixtures. Land improvements take me 15 years to write off. Furniture and fixtures take me 5 years. But now we also have, right now, as currently is in the law, we have this thing called bonus depreciation. And bonus depreciation, I say it's an election, but really it's kind of the other way around. You elect out of it. You either take it or you elect out not to take it. Most people elect to take it. Here's why. It basically accelerates the write-off. I write off everything with a class life of 20 years or less I can write off in the first year. So if I had a driveway, let's say I have a rental property. Now I've had it for a few years and I have to go in, I have to put a driveway in. And you come and say, well, I got to put a driveway in. I said, well, that's a capital improvement. You're not going to expense it as a repair or maintenance. You're putting a whole driveway in. You got to do something with it. And so, man, the thing cost me $12,000 to put that driveway in. I said, yeah, that's bad. But I've got this thing called bonus depreciation. And since that driveway is a land improvement, I can write off in the first year. And then everybody seems to get a little more happy about it. It's very important that we allocate and we figure out what the cost of these assets are when we're buying something. When you're paying for it, if it's existing property, it's really easy to identify. When you're buying a property, it may benefit you to do some things, and we'll talk a little bit what those are. One thing about bonus depreciation you need to know, or several things, but one of the things you do need to know about bonus depreciation is for 2023, the bonus depreciation rate's 100%. It's been that way for the last 5 years. It's scheduled to reduce to 80%. So let me give you the example I gave before. Let me change the amount just to make the math easy. Let's just say it's a $10,000 driveway. So if I did it in 2023, I could write off $10,000 under the bonus depreciation. If it's in 2024, I can write $8,000 of bonus depreciation. I take the other $2,000 of that 10 I spent, and I depreciate that over 15 years. So I still get the deduction. All the bonus is doing is accelerating. It's letting me front end my deductions. I'm getting it now rather than taking it over time. Beneficial, very beneficial. Can create a situation that creates losses. And you go, well, Carl, you just told me that passive losses aren't very useful, but they could be if you have passive income from other rental activities. So just kind of keep that in mind. All right. Having said all that, let's go in for just a second and go to an example. So this fictitious person named Mac and Sally Brown, or maybe not, they purchased a modest home in Figure 8 for $10 million. And they decide they want to treat that as real property. So they are which is what we typically see. The typical way people will do that is they'll just come in, they'll give it to the tax preparer. Tax preparer will go look on the tax rolls, and they'll say, hey, the tax values, let's see, land was $2,600,000 was the tax value, and the building was $1,159,000. I don't know if they got a good deal or not, but the tax value said the property is only worth $3.76 million, and I take a percentage of what's my land and I allocate my $10 million purchase price between land and building. And I say, well, hey, my depreciation for the first year is $112,000 roughly. That's the first way. And that's the way typically most people do this. However, we go, guys, that's a big piece of property. There's a lot of things in that property. Maybe what we do is get a cost seg study done, but we usually have an engineer do this. Doesn't have to be an engineer, can be other folks, but engineer is your best way we do this. We do this a lot when we're using commercial buildings, but these big properties like this, sometimes we'll do this. Why would we do it? Well, let's say, for example, that this thing had a pool, and it's a pretty nice pool, and it's a $60,000. I said, well, that's a $60,000 pool. That's the value of that pool that they bought it. And there's a beach walk that goes all the way out, and it's one of those nice beach walks. That's $15,000. They got a big, nice circular driveway. It's $32,000. They got a great big kitchen appliance package for $30,000, hot tub, TV room equipment, LVT carpet in certain places. And so all of a sudden, all those land improvements and that furniture and fixtures, now we can take bonus depreciation for those. So I can write all of that off. Well, that's a lot, guys. And all of a sudden, instead of $112,000 the first year depreciation, my first year depreciation is $317,000. Certainly something to think about when you're buying property, or especially if you're building property. If you're building property, is a lot easier because you can get these costs from your contractor. But if you're buying property, it's something to think about. If you have, and some of this is just looking at the property, what's there, what's in that property. These things matter. And another thing I would say to you is, if you're buying a piece of property from someone and they have some of this stuff in there, you need to get something in writing. Most of the time, they're not going to, the seller's just going to say, well, you're buying the whole property for X. Get something down in writing in your contract somewhere that part of that is, I'm buying, there is a driveway, there are all these things. Documentation really helps you here. If it's a lot, again, we recommend getting a cost seg study, but it's certainly worth exploring. We've been able to find a lot of deductions for folks here in this space. And that really kind of, so again, back to Mac and Sally Brown, they do this first year and they have this great big loss. And you go, well, Carl, it doesn't do any good. They got a big old passive loss. But yes, they carry it forward the next year and the next year. And they're going to have rental income. And all of a sudden those deductions help them. And so I'm eliminating some income tax in the early part of this investment. And that may be beneficial to them. So that's something that part we use quite a bit. All right, so let's move on for just a minute. So I'm gonna leave the whole depreciation world now, and let's go over and talk just for a minute about mortgage interest. I want to point out one thing, and I meant to do this, and I'm sorry I didn't do this before. When I was doing the rental income and deductions, notice the one thing that was not on that list of deductions was mortgage payments. Nowhere on there was there what's the mortgage payment? I have so many people will come in, so I'm making money on this property. My mortgage payment is more than my rent. I don't care because that's not part of the equation. What is part of the equation is what your mortgage interest is. And you say, well, hey, the first part of the loan, most of it is mortgage interest. Okay, fine. But it's not all of it. There is some principal, and we're seeing lower rates. If you had a mortgage that was at 6% now, well, that's a lot of that's going to be interest. If your mortgage is at 3%, a whole lot less of it's going to be interest. The reason that matters is what can I deduct? I can deduct the mortgage interest. So can I deduct mortgage interest? I can if the loan that I have on the property was used to buy the property or for improvements to the property. Pretty simple. But what we see a lot of times is people will have loans on property and they use the money for something else. That happens. And so if that happens, we have to start tracing where'd the money go. And there's a whole set of rules on the interest tracing rules that we have to look at to determine what that is. One other thing we see a lot. Notice I didn't say that to take the deduction that the property had to be the collateral for the loan. So we see this a bunch. Somebody will have some other properties. They'll have a loan somewhere. Maybe they've got a nice portfolio of stocks and they're going to take a margin loan because they can get a nice easy rate on it and they want to buy some real estate, they want to diversify themselves in real estate. Can I deduct the mortgage, the margin loan interest? Well, you can, and these are interest tracing rules. They say, well, hey, this $300,000 that came off this portfolio and I'm using it to buy property, I can use that interest off that margin loan as part of my deductions on my rental property because that's what I use the loan for. I hope that kind of makes sense what I just said there. But I'm just trying to say to you, we try to trace where the money goes. That's the biggest thing I can take away, or big takeaway there. So let's talk about disposition strategies. I'm gonna run out of time. I'm going long. Ask the guys, the folks who are monitoring me, let me know where I am here. I don't want to get too far out ahead of everybody else. All right, let's talk about disposition strategies real quick. So when I'm looking at the gain or loss, I take the sales price, any closing costs, commissions, D stamps, those kind of things, and then I deduct from that my net cost basis. My net cost basis is original cost less any depreciation I've taken. Again, note, I am not considering, I don't care how much mortgage you paid off for purposes of calculating the gain or loss. It doesn't matter. I have a lot of people come in, I didn't make any money. I didn't get any money because I had to pay off this mortgage. Again, if the mortgage was used for something else, it doesn't matter. So just when we're calculating this, we look at what these three elements, sales price, closing price, net cost basis. Those are the only three things we're really going to consider to figure out how much gain you have. Now, the kind of tax you pay depends on the type of gain there are. And there's a bunch of different kinds of gains, or I'll say basically three different types of gains we encounter in residential real estate that we have to deal with. We have to recapture prior depreciation first. I'm going to go through an example in just a second. And then if we have excess gain and we've held the property for more than 12 months, we get long-term capital gain, and that's the nirvana. Everybody's after that. If I'm going to have income, I want long-term capital gain. Why? Because it gets the best rates. And let's look at an example here. So potentially I've sold a piece of property for $400,000. I've got closing costs of $26,000. My net sales price is $374,000. And now I've looked at my net cost basis. I paid $256,000 for the property. For that piece of property, I paid $256,000. I've got land I've allocated 65,000 land, 170 buildings, land improvements, furniture, appliances. I've depreciated some of that down, and now the net asset is only 204. So that's why I'm going to calculate my gain. I'm going to take the 374 less the 204 net after my depreciation, and I'm going to gain $169,000. How do I tax it? Depends. This is what the depends. That is our favorite answer, by the way, to every question you ask. It depends. Again, 4 million words we're dealing with, so just kind of remember that. So the first thing I do, I'm going to calculate the tax on my recapture. I'm going to look at recapture of this land improvements, and that's what we call 1250. That's ordinary income. I'm going to assume that you're in the highest bracket. That's 37%. I'm going to assume that it's subject to the NIIT, net investment income. A lot of folks, their rentals are going to be subject to that, 3.8%. And then North Carolina comes in at 4.99. And all of a sudden I'm paying 45.79% on that gain. I don't like that. I want to make this as small as I can at this point. So I don't want to pay that tax, but I'm going to have to pay about $9,600 on that part of the gain. I do the same thing with the depreciation I took on the building. I have only in tax law do you have something called unrecaptured 1250 gain. It gets taxed at a special rate. Its rate's 25% federal plus the 3.8 plus the 4.99, and that totals of 33.79%. And then my long-term capital gain is the rest. That's the excess. And so 118,000, pay that at 28.79. You go, well, I heard it was 20% the rate. Yes, 20% rate plus 3.8 for the NIIT. I'll talk a little bit about what that is in a minute, plus 4.99. And you go, well, that's not great, but that's better paying long-term capital gain than it is recapture. And that's about a 17% delta difference between those two. Why did I take you through all that? Oh, and I threw in these tax. If you really want to see where rates break down and how much income you need to be in which bracket, I gave you a table here, just lifted right off of one of our guides we have on our website. So you come to me and you say, well, that's you're going to pay the $50-some thousand. Oops, let's go back here just a second. I tell you, well, most of the time people come in and say, here, I'm going to sell this, what's it going to look like? And we do some kind of thing like this. And we say, well, you're going to pay about $54,000. You go, oh, gee whiz, I don't want to pay $54,000. What can I do? One of the things we do a bunch with folks is we do a 1031 exchange, otherwise called a like-kind exchange. It is a technique to defer the gain. You're not making the gain go away. One day you'll pay tax on that gain, perhaps. We'll talk about one way to get away from that. You've got to reinvest the net sales proceeds. So back to our example before, remember that the top was $400,000, then was $26,000 of closing costs. $374,000 is a magic number here. I've got to reinvest at least $374,000. I can't touch any cash from the sale, and I can't have access to it. So the way people typically do this is they use an exchange agent. I'm a seller. I'm selling. Charlotte's buying. Brad is my agent, is my exchange agent. Here's the way it works. Charlotte comes to me, I want to buy. Great. I want to do a 1031 exchange. Charlotte says, well, I don't want anything to do with that. I'm just going to pay you the money, buy the property. I'm going to go about my business. Then I need somebody to handle her side of the equation because I need somebody to take that money. Don't give it to me because I want to reinvest that money. And under these rules, I can do the following. We can hire Brad as our third-party agent, and only certain people will be hired. Every attorney in town that deals with this knows agents that can do this work and are qualified. You got to be qualified to do it. Let's say Brad is qualified in this case. Brad holds the money. Within 45 days of the closing, I must identify the property or properties that I want to reinvest in. And within 180 days of the closing's everything. That's the magic date. Within closing of that first property that I sold to Charlotte, within 180 days of that, I have to get that the replacement property. I have to close, have Brad deliver the money, and buy the property. There are other parts of this rules. I cannot stress enough that this 1031 exchange is all form over substance. The form is not right. It doesn't matter what you did. If you did everything else right, but you don't have the right kind of form, you're in trouble. You always have to have it in writing. You always do the writing before you close on the property. It's best to know you're going to do this before you go sell to somebody. Put it in your contracts, those kind of things. Again, I'm not a lawyer. I'm not giving you legal advice. I'm just telling you, if you don't have this thing in writing, it doesn't matter to the IRS if you did everything else right. Don't touch the cash. Why would you do that? Back to our example. I sell for 400. I net 374 after closing cost. My taxes are 54,000 off that 169,000 on the $170,000 gain, and I have this much. I have $320,000 roughly to reinvest. Or I can do a like-kind exchange, and now I can reinvest the whole 374. I'm only going to pay tax on that $169,000 gain, which does reduce the basis. Excuse me. Sorry about that, guys. Flipped. It does reduce the basis of this new property. So that new property that I buy for $374,000, my basis is 374 less about 170, because this gain is going to reduce the basis in the next property. So I'm going to have lower depreciation on the next property, but I'm paying tax. Most of my clients don't like paying tax. They really don't like paying tax. They tell me how much they don't like paying tax. And I don't like them pay tax either. And a lot of clients will use this method to rinse and repeat. So you buy the next property and it goes up in value, sell it, and you do a like kind of exchange. You just keep doing it. What happens? You end up with a piece of property that's completely paid for, it's cash flowing beautifully. It's a nice piece of property or properties. Remember, I told you it didn't have to be one property, it could be properties. There are rules if you want to go more than 3. I don't have enough time to go through all that. The other thing I will say is there's one way to beat the IRS on this one. If you pass away and you got the properties in your name, under current law, nobody pays tax on that gain. We step up fair market value, we don't pay tax. Guys, I am almost out of time. I think I'm 9 minutes before for close. So I only touch on NIT for a minute. There's a special tax of 3.8% that'll apply to your rental properties and apply to the capital gains from those rental properties if your adjusted gross income, if you're a single person, your adjusted gross income is $200,000 or more, this applies. If you're married filing joint, it's $250,000. You can't, there is an exception if you're a material participant. We talked a little bit about that before. And if you are a material participant in your rental properties, if you can qualify under that rule, you can also get another deduction called the qualified business income deduction. And that's something for another day. I'm out of time. I'm ready for questions if you have them. If you're awake, I'm ready for questions. If you're fully caffeinated, maybe you made it. So.
Carl, we did have a question. Somebody typed in for a cost basis when converting a primary residence to a rental property. We run into that a lot where somebody
Okay, sure.
and they want it to become a rental property.
Okay, so the rule is it's the lesser of your original cost basis or the fair market value when you converted it. That's the general rule. So there are some issues dealing with how you do allocations in those cases, but that's basically the rule. So for most people, for most folks, Charlotte, we're looking at what you pay for it. Because generally, this hasn't always been, we've been in a time when this wasn't the case, but generally property values keep going up, right? So they bought the property years ago, they want to convert it. That's what we're looking at. We're usually looking at cost basis, and we're going back looking at records. That's a great, I'm glad somebody asked that question because that's something that we run into quite a bit. People won't keep their receipts. If you're doing stuff to your property, your home property, you say, well, I don't worry about it because I heard from my accountant that I'll never pay tax if I sell it. Yeah, that's true. But if you ever decide to convert it to something, then you're going to need those records. So keep your records. It helps. If you're making capital improvements to something, keep them. I mean, that's the best way I can tell you. I'm working with a couple right now. They're out of New York and they're selling this house, big old chunky gain, and they haven't kept records and they've had it for 30 years. It's a nightmare trying to figure that out. But that part I would tell you is the biggest thing is keep records.
And, we had another thing come up around Christmas this past year. We had an owner that purchased a property during the month of December, and he did a whole bunch of work to it, getting it ready to rent. But he said that he needed to have it advertised before the end of the year so that he could claim all those expenses for all that. I mean, he did some great things to the property. We were super excited and it rented very quickly.
Right.
But is it a calendar year situation for that?
Well, so what he's trying to do is what we call getting the asset placed in service. So for you to start deducting things on a rental property, it's got to be in service. Now, how do you determine if a rental property is in service? Well, that's facts and circumstances. One of the facts and circumstances are, do you have it listed? Is available for rent, right? Is it there? Now, if I buy a piece of property that's just beat all to pieces and no one's going to go in there, and I'm going to have to do a whole renovation for the whole month of December, well, I'm probably not going to be able to say it's placed in service. But if I can get it placed in service in that year, then maybe I've got some deductions I can take. And maybe I'm assuming in that case, he was probably doing some stuff. He made it look great. He did some great stuff to it, but maybe it didn't rise to the level of betterment, that UOP thing I talked about that lost probably half our audience. That's the kind of stuff that we try to look at clients and say, okay, we can get it if we can get the thing in service in time, right? And that's what I think that's where he's going. He's trying to make sure it's in service. And he's trying to show it, and he's doing it definitively by an agreement. Say, oh, look, it's listed, right? He can point to that if the IRS questions him on it. He's got something definitive.
That's a good answer for that one. I like that answer. Also, if I convert a primary residence, do I lose the capital gain exclusion forever?
Oh man, this is a great question. Great question. So, It depends. How do you like that answer? I told you it's my favorite answer. So it depends because this is a typical scenario. Somebody has to move quickly. They have to move. They can't sell. Now, I know that we've been in an environment where you could sell it as soon as you list it, or even before you list it, it got sold, or 3 people in your driveway before you put the for sale sign up. But what happened in the past, we'd see this a lot. Folks have to move. They got a piece of property. They're running out of time. They're not sure if they even, and they're not sure I'm going to stay. I'm moving to Florida. I don't know if I'm going to like it, right? So maybe I'm going to hold my property for a while. Well, so if I held the property, so we have this rule, this home exclusion you're talking about. I'm going to go through a little bit of law. It says the following. It says you can take this exclusion. Exclusion means I never pay tax. I can take that exclusion as long as the property was my principal residence for 2, and I owned it for 2 of the past 5 years. So what does it allow me to do? It allows me to move out of the house, rent it for 2.5 years, not quite 3, sell it within the 3-year period, and I can take the exclusion. So I can still get the exclusion. I don't lose that. If I took some depreciation, which I would have during that period of time, I do have to recapture that. That recapture depreciation thing I talked about before. If I have a gain, I have to pay tax on that depreciation, but the vast majority of the gain that I earned over the 20 years I owned the property before, I don't have to pay taxes on that in that case. It gets real choppy if I own the property, I rented it for a period, then I use it as a principal residence, then I rented it for a period of time, then I use it as a principal residence. The rules are fairly complicated. Now we're going to start losing some of that exemption. The exemption is $250,000 per taxpayer. So if I'm married, it's $500,000 for husband and wife. But I can lose some of that exclusion if I have this choppy way where I've rented it in the interim period. But if I rent at the end, I don't lose the exclusion at all. I get the full amount. The only thing I have to recapture is that depreciation that I took during that time. So if I took $10,000 depreciation in the 2 years, I've got to recapture that if I have a gain of that much. I hope that makes sense. We get that question a bunch.
I do. And I think sometimes when you said at the very beginning that you're not an attorney, oftentimes when I'm talking to owners, they'll say, I don't know whether to sell or to rent, and I'll go, well, have you talked to your accountant yet? I kind of redirect and say, hey, you need to talk to your accountant, but I feel like you've given us a whole lot of information. And I want to just thank you so much for sharing it, because it was incredible information. It was very well thought out. And I want to encourage anybody that was watching the webinar today that in a couple of days, we're going to have it posted to our website, wilmingtonrent.com. And you can view it again if there was something you had a question about or anything. And we'll be doing some future webinars again. We might even need to call you back, Carl, to dive in a little deeper into some other stuff, because I feel like we just kind of scratched the surface.
Well, I'd like to end a couple of things. I agree with you. Thank you, anybody who listened to this, who endured it. Thank you so much. I will say one thing. If you're driving now, you probably need to get some caffeine before you leave. I would suggest that. And if you've got additional questions come up after viewing some of this stuff, if you want to take them offline, Charlotte's group, Brad, any of those folks, if you would get those questions to them, if they get them to me, we'll be glad to try to answer them offline with you. And Charlotte, thank you so much for having me. I really do appreciate it. And thank you, all y'all who listened. Really, I appreciate that.
Well, we appreciate it so much, Carl. Thank you very much.
All right, guys. Y'all have a great afternoon.